Welcome everyone to today's lecture. Last week we already started our discussion of the Alexgoldschmidt Model, and I want to repeat this just in a nutshell to bring everyone back to the same level so that we are able to fully understand not only the beauty but also the mechanism and the way Alexgoldschmidt showed that you can come up with an arbitrage-free price for a derivative, actually for any derivative. If you remember our discussion from last week, you will see that we started with an asset model, a stochastic process for the time evolution of the stock price, of a stock price. We argued that we have a stock, S, or any type of underlying actually. This stock price is follows a stochastic process. So we have ST at any point in time. The behavior of the stock price is random, and those random variables at t equal to 1, t equal to 2, and so on, all those random variables can be different. So we don't have a constant random variable, but a stochastic process. And obviously, the underlying price is a stochastic process in continuous time, meaning that the price can change in 1 day, it can change in 5 minutes, it can change in 1 hour, and this is actually quite realistic when it comes to market microstructure, the foundation of the way the stock price, the stock market works, and when it comes to nowadays high-frequency trading. Because as you might know, the stock price is a result of transactions being done on a stock market, and these transactions can take place in 5-minute, 10-minute, 5-second intervals. And if you just go down in such a detail to the high-frequency data, you will see that actually you have a price at any point in time. It can be constant for 5 minutes or for 5 days, but you can observe, if it is technically possible, you can observe the price at any point in time. So a stochastic process in continuous time makes more sense than a stochastic process in discrete time. We saw that a very simple, even though if you are not studying mathematics and if you are not versed in stochastic analysis and stochastic calculus, it's not so easy actually, but in mathematics, a very simple model that can be used to describe such a time evolution is a so-called diffusion process. Last week, we saw all the fine print that comes with a diffusion process, meaning that you start with a Brownian motion, aka Wiener process, then you switch to a geometric Brownian motion. We saw that a geometric Brownian motion or a Brownian motion is a very simple stochastic process that is somehow related to the normal distribution in the sense that the increments, the changes of the process, they are independently normally distributed. So it's a very simple process, but it's not a normal distribution. We are not assuming a normal distribution for one random variable, but in fact we have a random vector, a set of random variables, a stochastic process, and the stochastic behavior of the stochastic process is governed by a normal distribution. Those increments are normally distributed. And then we saw that actually Brownian motion, Wiener process, is not yet flexible enough to model the commonly found behavior of a stock price. So we said, okay, let's take a Wiener process, let's take a Brownian motion, and let's insert a non-zero drift. And you can make it even more complicated by including a drift that now depends on the process and time, and you can take a non-constant volatility. So instead of simply writing sigma times dw here, we're taking a function b. It's still a diffusion process. It's just a little bit more complicated, in other sense more flexible. We take this diffusion process, even though in stochastic calculus we know that this is a differential equation and it needs to be integrated, and you can switch from integration to differentiation, zwischen ableiten und integrieren. We are not interpreting this in this way, in the mathematical way, but we simply argue that a change in the stock price, DST, is given by a parameter A times the change in time plus some random effect we are inserting into this process here. And if we take this stochastic process, if we use a diffusion process, we were led to the point where we asked ourselves, how does a function in a diffusion process behave? Well, that's the central result of the lemma of Ito, that the diffusion process, ST, and a function in ST are actually related in the sense that here a change in a function v of s is again a diffusion process, only with a slightly adapted drift and volatility. We saw that here in the drift and the volatility component of the new stochastic process for the function v, we need partial derivatives of s, of the function v. Later on we have already seen that it makes sense to give those partial derivatives special names. Actually, these are the Greeks from option pricing. Those are the partial derivatives, the sensitivities of the option price to a change in the underlying price, to a change in the interest rate, to a change in time. But they also naturally pop up here in Ito's lemma as part of the new diffusion process for the derivative price. So this was Ito's lemma, and we saw that we need this to price any derivative. We then did a delta hedge, meaning that we looked at a portfolio that consists of one option, one derivative, and a number n, or in this case delta, of underlyings which we've sold short. So we have a long position in the derivative and a short position in the underlyings. And as in many cases in hedging theory and option theory, we are now interested in finding the optimal number, delta, that makes this portfolio consisting of a derivative and the underlying completely risk-free. So we are intending to do a full hedge, that's what we call it, a full hedge, and to eliminate risk completely from this portfolio. A little bit algebra now follows, and we see that in fact all of this becomes deterministic, and this means risk-free, if only this part vanishes and this part here vanishes if this here becomes 0. So we need to set delta equal to the option delta. And if we choose the number of underlyings we're selling short equal to the option delta, the partial derivative of v with respect to the underlying price, then we see the portfolio becomes risk-free. Yeah.
It's just one specific underlying. It's not like there are several different underlying, several different stocks. So it's just one stock, one
yes.
of the stock, and we just have several kind of number of the stocks, the shares.
Obviously, the underlying needs to be exactly the underlying of the derivative, because otherwise we would have, as you can see, v is a function in S, not in any other underlying. It has to be completely based on S as the underlying. Actually, I don't know whether I'm pretty sure there will be an extension of the Alexgoldschmidt model to the case in which you have several underlyings and where you have, but this will probably work, but it will only make it a little bit more cumbersome to do the math here. You might know that there are some things like rainbow options and some other exotic options where the price of the option and the payout depends on several underlyings, or the difference between two underlyings. So if you, for example, you have an option that pays out the maximum of, say, underlying 1 minus underlying 2 or 0, then you have two underlyings. And I'm pretty sure you can easily extend the Alexgoldschmidt model to this case where you have two underlyings, two diffusion processes, but it will still be the same principle. Obviously, this will not work if you're looking at the wrong underlying, right?
Yeah, it's just confused because we're talking about several underlines. It's plural.
Yeah. What I mean with several underlyings or with underlyings means like 10 stocks of the same company or 15 stocks. It's the same security, but you need to buy 1, 2, 3, or 5 underlyings. And as always, if something is risk-free, in an arbitrage-free model, it should give you, should yield the risk-free rate. We have the risk-free rate here. We do what we call a delta hedge. It's a perfect hedge, it's a full hedge, and then the change in the portfolio value, aka the portfolio return, should be equal to the risk-free return in case we've done the full hedge, and this is where the risk-free rate enters the Alexgoldschmidt model, because it should give you the same return as the delta hedged portfolio consisting of the derivative and the underlyings. So if you do this, you will get the Alexgoldschmidt stochastic partial differential equation. It's a PDE, it's stochastic, it's a stochastic PDE, and it states that for arbitrage reasons, the return per time from a delta hedged portfolio of the underlying and the derivative must be equal to the return per time of a risk-free investment in the same amount of the portfolio value. Okay. Now, this equation looks harmless at first. One would think that this is just a simple equation. However, it is not. Why? As you can see, even though we have some variables here, we have partial derivatives and S and S squared. And remember that S is still a diffusion process. It's a stochastic process, and this makes this harmless looking equation quite difficult to solve. Now, in many lectures on computational finance, actually, this is the starting point for the whole lecture. I mentioned this at the start of the semester that in at many universities, but usually in degrees on financial mathematics or financial engineering computational finance is synonymously used with option pricing. And I can give you one simple reason for this. At this point here, we'll next try to solve this partial differential equation. And in the very simple case of a plain vanilla option, a stock put or a stock call, European call and European put, it is easy to find an analytical solution. First of all, remember again the difference between an analytical solution and a numerical solution. Analytical means that you can solve for this equation and you get a function and you get the full definition of the function and you can write it on a sheet of paper. Like if I were to say, well, the solution is f of x equal to, let's say, sigma squared plus 3 divided by r. This would be an analytical solution. Just like in school, if you are not able to come up with such a solution, the only thing you can do is try your hand at a numerical solution. And this is the tricky problem here with the Black-Scholes model. In few cases, can you find an analytical solution? And that is usually the case for plain vanilla options. For exotic options, exotische Optionen, for exotic options, you cannot find an analytical solution. And the only thing you can do is to come up with a numerical solution. And you need the full firepower from numerical analysis to solve these equations. And this is why at many universities you can fill a whole semester just with numerical methods to solve the Black-Scholes model in case for some weird exotic option, in case you cannot find an analytical solution. Then you have to do it numerically, you have to do Monte Carlo simulation, you have to do finite differences, and then you can spend a whole semester just on all those different methods that might be a little bit faster, that might be a little bit better. We'll see some of these methods and some of these results, but usually that's what computational finance is referred to in these lectures. But this here is now the Black-Scholes equation, the Black-Scholes differential equation. We'll later on see the Black-Scholes formula. And to sum up the assumptions in the Black-Scholes model, again, the underlying follows a log-normal random walk. You can also loosen this restriction a little bit and use more complicated stochastic processes. The risk-free interest rate is a function of time. Underlying does not pay dividends. We can do delta hedging in continuous time without transaction costs, highly unrealistic. And the market is arbitrage-free. That's ideal, but might not be the case. Then we are given the Black-Scholes differential equation. Last week I gave you this very simple example of a differential equation that looks like this. Y, first derivative of y equals y. You remember that in this case we are looking for y as a function, f of x, and there are more than just one solutions available, and as soon as I provide you with something like this, you will be able to identify a unique solution. And then, you know, for example, in this case, it's the exponential function. And this is common to almost all differential equations. First of all, you need to find a function, not a number. Second, if there is a solution, usually you have an infinite number of solutions, and you need to set a boundary condition to find a unique solution. Kurz nochmal auf Deutsch. Differentialgleichungen, wenn Sie die lösen, suchen Sie nach einer Funktion, die die Differentialgleichung erfüllt. In dem Fall also hier die Exponentialverteilung. Und Sie haben fast immer unendlich viele Lösungen. Das, was Sie noch benötigen, ist eine Anfangs- oder Endwertbedingung, die aus dieser Menge an unendlich vielen Lösungen eine genau dann rausnimmt und die ist es dann. Aber wenn Sie nicht noch hier y von 0 gleich 1 setzen, haben Sie mehrere Möglichkeiten, was da rauskommen könnte. And in this case of the Black-Scholes differential equation, it's quite simple to see how to set the boundary condition. Why? Let's assume we solve for the differential equation and we might get something like this. And all those functions in between here, all these functions are possible solutions to the differential equation. Now, I said that you need a starting value or an end boundary condition, an end value boundary condition. In this case here, for any derivative, you know at least one value of the function. How much is the option worth at the time of the maturity? If you can buy the option now, or if you're the owner of the option and it matures now, what is it worth now? Do I let it expire or do I use the option? Meaning that, let's assume this is the point in time where it's the maturity here. Then, for example, you know this is the payout at maturity, and then this here, this is our price function. And if we are now interested in the option price, we need to look at this value here, because we are interested in the price of the option today. We only know what it will be worth after, let's say, 1 year. Conditional on the underlying price at t, obviously. Okay. Now here, at this point, we now let some physicists and mathematicians help us for the Black-Scholes partial differential equation. One can see that it's quite close to the so-called diffusion equation. And you will find a solution in very simple math books. You see here the solution of the Black-Scholes stochastic partial differential equation depending on the payout profile P. P is a function. We haven't spoken about P yet, and you can see this is the solution. The function V is yada 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 times an integral that in the end depends on P. P of S dash. Now all the other remaining components of this formula, they are given and they are independent of the derivative. If you now want to price an option, choose P accordingly. If you want to price a swap or any other type of option, a plain vanilla option or a Bermudan option, the only thing that changes is P, the payout profile. And conditional on the type of P you are looking at, on the type of derivative, P will change, and thus the question whether this integral can be solved or not will be answered. The only problem here is the integral. Otherwise, you would be able to solve for the option price in any scenario. So different payout profiles, different types of derivatives lead to more or less large numerical problems. In some cases you will find an analytical solution, in some cases you will not. And as an example, we'll consider a plain vanilla call on the underlying. We thus have payout profile depends just on S, the underlying price. It's the maximum of S minus the strike, or 0. So just insert it here, and then this will be written like this. Actually, as you can see, you have to change 0 to K. This will be, and you will have K here, and you no longer need the maximum function, and this integral, this can be solved. For some other derivatives, it cannot be solved. In this very simple case, you will find an analytical solution. And what you do is, you multiply the E function into the parentheses, you split it up into two integrals, and you actually do a little trick. You do not solve for the integrals, but you only see that, well, actually the integrals, they look like the cumulative distribution functions of the normal distribution. And if you remember the start of our lecture, the start of the semester, I told you that the CDF, the cumulative distribution function, or the density function for the normal distribution, cannot be solved for analytically. You need numerical methods to find those values for the normal distribution. And we are actually not solving this really analytically. We are only substituting a very complex remainder in this equation by phi. Yeah? You have some thing here minus la 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 la, and you just say, oh, by the way, this is the CDF of the normal distribution. And then it will look like this. And this is actually what we have here. The arbitrage-free price of a European call option on a non-dividend yielding share is given under the assumptions of the Alexgoldschmidt model by price of the option conditional on the stock price as the volatility, the strike, the current interest rate, risk-free interest rate, current point in time, and maturity is given by stock price times phi at D1 minus strike discounted continuously times phi of D2, and D1 and D2 are given below. Now, why am I forcing you to learn this in such baby steps? When I studied business administration, I was only given this formula. I was told this is the Black-Scholes formula to price a stock option. And if you're only given the formula, and if you have never seen the derivation of the model, you will miss out a lot. First of all, it makes sense now to speak of the Black-Scholes price of a derivative, of an option. Why? Because the Black-Scholes model can be applied, basically can be applied to any derivative. Plain vanilla option, exotic option, American option, Bermudan option. We haven't made any assumption on the type of derivative. At some point, yes, we had the payout profile, and that changes a lot. But the Black-Scholes price, and you will see it, the BS price of the option is given by yada, yada, yada. It makes sense now to speak of the Black-Scholes price, because the Black-Scholes model is not really a model for one option. It's rather a pricing framework for all types of derivatives. And you might end up in more or less numerical hassle depending on the type of derivative. Second, one can try to interpret all the terms here in this equation. I've never tried to do that because I don't think there is too much economic sense you can interpret in and out of this equation. What you can do is you can see that under all these assumptions and with the diffusion process and geometric Brownian motion being entered into the model for the stock price, it doesn't really surprise too much that in the end the normal distribution comes out of it again. But the beautiful thing here is that you only need the assumption of the Brownian motion or the diffusion process as input to see that again the option price and the derivative price here is given by this formula. And it's kind of a little trick here that you even for this you don't have an analytical solution. As you can see, we still have the integrals inside the CDF of the normal distribution in here, but obviously this equation it can be solved for. You can take a textbook on the values of the CDF of a normal distribution and you could solve for the option price even without a computer. That's quite simple. Okay. That's the Black-Scholes option pricing formula for this type of derivative. then it is no big surprise that if you change the type of option, you will get a Black-Scholes price again, hopefully. If we look at a put with PS equal to the maximum of K minus the underlying price or 0, it looks quite similar. And the Black-Scholes price for a digital call. What is a digital call? A digital call is just like a plain vanilla option, like a plain vanilla call or put. The difference is that instead of the difference between the current underlying price and the strike, or the other way around, you will be paid out 1 if the option is in the money and 0 if it's out of the money. In other words, this will be a cheaper option because it will only, best case scenario, it will pay out €1. It will not pay out the difference, but only €1. So it will be cheaper, and if you have a digital call, the payment profile, the payout profile will then be payout profile of S is H, and H represents the so-called Heaviside function. The Heaviside function is a special function in mathematics that gives you the value 1 if the difference is positive, if the argument of the function is positive and 0 otherwise. And as you can see, the Black-Scholes price is even easier and simpler than before. So this is the Black-Scholes price for a digital call. Now, let's look a little bit into the Black-Scholes price of a European call. As you've seen, we need the option delta right in the middle of the model's derivation. And the partial derivatives are obviously the sensitivities of the option price with respect to the model's input parameters. Now, dynamic hedging strategies cannot be implemented perfectly, especially because of transactions costs. But sensitivities, they allow the risk to be managed in semi-static hedging, and they can be used to calculate risk capital. We have also seen this before, that sensitivities can be used, for example, in scenario analyses. And in fact, these sensitivities for traders are much more important to them than the option price, because you're only using options in most cases. You will be using derivatives and options for risk management purposes. You're very much interested in the sensitivities and the option Greeks, because these are the parameters and these are the figures that tell you something about how good an instrument this is for managing risk. And these are called Greeks. Let's start with the option delta. It's the dependency on the starting price using a partial derivative of the price function according to S. The first derivative is called the option delta. And in the Black-Scholes framework, you can see that it can be calculated directly. And you need it to perfectly hedge one portfolio of one derivative with delta underlying short. You also have the option gamma. The option gamma is the second partial derivative with respect to S. This is the option gamma for a call. That's why it's called gamma C. It is given by phi of D1. Phi denotes the density of the standard normal distribution. Gamma is always positive. Large values of gamma rise in price ranges where the delta changes rapidly and where frequent changes to the delta hedging portfolio are required. And approximatively, the risk of semi-static hedges can be further reduced over the short time window by constructing an overall portfolio that is gamma neutral. If you have a portfolio that is gamma neutral. Theta, like in T, as in time, it's the sensitivity of the option price with respect to maturity. Theta is larger than 0. Arbitrage-free price of the European call option is a growing function in terms of maturity. And we have rho and vega. Rho of the call option in Black-Scholes for a call is given by this expression. Describes the sensitivity of the option price to the risk-free interest rate. Rho is strictly positive, so the option price is growing in R. Vega is not a Greek letter, but still it's considered to be an option Greek. It's the sensitivity to the volatility. Again, strictly positive. And it shows that the Black-Scholes price of a call option is a growing function in the volatility. So if you have a call option, your price of the option increases with volatility. Why is that? A call option gives you the opportunity to buy at, say, 100. Why is the option price an increasing function in the volatility? Yeah.
Because, of course, you can win more if volatility is high.
You can win more, and the probability of the stock price moving the option into the money is higher than if you have virtually no volatility. Now, let's assume the stock price has virtually no volatility. Then it would be a flat line. And if the flat line starts at 98, the option has no value. If now it starts again at 98, it might move the option into the money. And if the volatility is large, then we only need one of these points and we can exercise the option and make a huge profit. So vega is strictly positive for the call, and the option price is an increasing function in vega. Now at this point I want to comment on why it's called the Black-Scholes model, and not just the Black-Scholes model. In many cases, in many textbooks, it's just called the Black-Scholes model, but it is, in fact, Robert Merton received the Nobel Prize. Scholes had already died. I think Black. I think Fisher Black had already died. At least one of the two got the Nobel Prize, plus Robert Merton from MIT. Does any one of you have an idea why it's also called the Black-Scholes Merton model? What Merton had to do with this? Because Black and Scholes came up with the idea for financial derivatives. But does anyone know what Robert Merton is famous for? No, okay. Now, do you know anything else that can be viewed as an option outside of financial markets? Anything? The firm itself. Why? Imagine you buy a stock of, say, Daimler. What will you receive? You are the shareholder of Daimler. What is your payout?
So, first of all, maybe a dividend. And,
Let's assume dividend.
The return you can expect from the volatility of the share.
Yeah. You're again thinking about this as an investor in the sense of buying a stock. You have to think it from a different perspective. If you are the owner, if you are the shareholder of a company, what will you get in case the company is liquidated? In case you close down the company, sell off all assets, what will you get? If you are the shareholder, you will get everything the company is worth. If you have 100% shares, if you are the majority, the sole single owner of a company, you will get everything, right? If it's sold off. After what? Yeah. And that's the scenario in which there is enough money to pay back debt. What happens if there is not enough asset value to cover the debt? You have limited liability in the case of a share company, a stock company. So you will get, either you will lose your investment, but you will not have to pay anything in addition to your stock investment, or you will get the residual value of the asset value minus debt. Debt, and then now it's quite simple. You can see that for equity owners, for shareholders, shareholders have what? They have a put option on the firm value. They have a call value. They will get the asset value. They will profit from an increase in the stock price. And they only have to pay back the debt. But debt is fixed in this model. And how does it look for debt holders? For companies that have given loans to the company? Yeah, it's the opposite round. Yeah, just the opposite. Obviously, debt holders will get D at best. If you've given 1 million as a loan to the company, your repayment will be 1 million. Best case scenario. If there is not enough asset value, if the firm value is low, and the firm cannot repay its debt, then debt holders will have to accept a haircut on their investment. Best case scenario, they will get back the 1 million. And now suddenly you can see two things. First of all, this is Merton's idea. This was Merton's idea to look in parallel to Black and Scholes, to look at the firm value and the position of equity holders and debt holders of a firm in this way of looking at the firm using this model. And they did basically the same thing with different applications. So it's Black-Scholes Merton model. And a huge new model now opens up for you, because first of all, you can interpret the firm from an option perspective, from an option pricing perspective. Second, everything in life is an option. And this is why we now have so-called real options. If E.ON, RWE, RWE, if they decide to fire up a gas plant or close it down, it's an option, it's a real option. Ja? Lassen Sie das Kraftwerk heute laufen? Ja, nein. Ja, machen Sie einen Überschuss? Nein, verlieren Sie zumindest kein Geld, wenn Sie drauf zahlen müssen. Everything or many things can be modeled as so-called real options, and the firm itself is also more or less a type of real option. Next, what can you immediately see from this perspective on the firm? You can see the different incentives debt holders and shareholders have, and suddenly you can explain theoretically why shareholders and debt holders have different incentives and different goals. Shareholders are interested in what? In volatility going up. Shareholders want risk. Risk, in the sense of higher volatility, means that their option is worth more. Debt holders will lose money in case sigma, the volatility goes up. And you can see this very basically in this very basic result. You can see this from the sensitivities for plain vanilla options from the Black-Scholes model. And this is, by the way, this is the theoretical argument why shareholders will be interested in managers going for risk. And it goes on and on. In fact, you might know that sensitivities play a larger role when the option is at the money and sometimes when it's deep out of the money. And you can use this model and you can use this theory to explain why shareholders have an incentive for so-called gambling for resurrection. If you have a company that is already bankrupt, maybe not on paper, but everyone knows it's bankrupt, managers and shareholders will have an incentive for so-called gambling for resurrection, meaning they will use up all available capital and even increase debt if that's still possible, and they will make one last gamble to save the company. Why? Well, it's quite simple to see this from an option perspective. If the option is so deeply out of the money, shareholders have already lost everything. Their loss is bounded below by zero, and everything the company now does can only profit shareholders. If they burn up debt holders' money, they don't have to pay back anything. If the gambling for resurrection is successful and the company again becomes profitable, then the profits will go to shareholders. So you can easily see if the option is out of the money, aka the company is already bankrupt, shareholders will have very different incentives than debt holders. Debt holders will be interested in minimizing their losses. So this is very, very interesting, and this can be seen quite frequently in financial theory, that if you see that managers, companies have the option to do this or that, or if it's related to the firm as a general concept, you can use option pricing to explain the different behavior of shareholders and debt holders. Ist, denke ich, soweit allen klar geworden, ne? Also, dass man ein Unternehmen auch als Option begreifen kann für die Aktionärs- und die Fremdkapitalgeber. Und das Schöne ist, in der Tat, sehr viele Theorien basieren eben darauf, dass man das Unternehmen so auffasst, dass man diese Merton'sche Sicht auf das Unternehmen sich heranzieht, und dann können Sie direkt das Verhalten der Akteure erklären und auch die unterschiedliche Motivation, warum Aktionäre sich anders gerne verhalten möchten, oder das Unternehmen und die Manager zu bringen, sich anders zu verhalten als Fremdkapitalgeber. Okay. Leverage effect of call options. For call options, the absolute change in value of the option price is always smaller than the corresponding change in the share price. At the same time, the relative change in value of the option price is greater in amount than the relative change in the share price. And this observation can be interpreted as a leverage effect for call options. Okay. Then, because these are frequently used phrases and concepts, let's look at the volatility skew and the volatility smile. Now, European call and put options are traded liquidly on the financial markets. You can observe the prices, and this is one of the few derivative markets that is actually quite transparent. To model the same prices in the Alexgoldschmidt model, you need the current stock price, the strike, the maturity, the interest rate, and the stock volatility. Now, if you use all but the volatility as fixed parameters in the Black-Scholes pricing formula, but I should show it in the formula. Again, this is the Black-Scholes option price. Now, we can use sigma, R, T, and S inserted on the right-hand side, and we will get the price. Let's assume we insert all those parameters and we get a price of 6.53. Now we'll assume the price we can observe on the market is 7. The market price, the empirical market price is 7. And then we say we use S, we use phi, D, and so on, but we leave out sigma. We are leaving out the volatility, and we say it's a function in sigma. And then we solve for sigma, and it will give us sigma I, the so-called implied volatility, the volatility that is implied by the Black-Scholes model. Implizierte Volatilität bedeutet nichts anderes, als dass Sie das Black-Scholes Modell nehmen und Sie passen quasi, Sie machen nichts anderes als ein bisschen Reverse Engineering. Das Black-Scholes Modell gibt Ihnen ja einen Preis, der ist der theoretische Preis. In der Realität haben Sie aber auch einen Preis, den Sie am Markt beobachten können. Und wenn Sie den einfach auf der linken Seite einsetzen, auf der rechten Seite hätten Sie auch alle Parameter, bis auf die Volatilität, die Sie auch erst irgendwie schätzen müssen. Und wenn Sie die einfach als unbekannt annehmen und nach Sigma auflösen, bekommen Sie die implizierte Volatilität. Die Volatilität, die über das Black-Scholes Modell und den tatsächlichen empirischen Optionspreis impliziert ist. Now with the implied and the historical volatility, you can compare the two. And if you compare the two, you will see that first we'll compare historical and implicit or implied volatility. It's usually implied. And the implied volatility is the volatility under which the Black-Scholes model delivers the same price as in the market. For different strike prices and maturities, we can then determine the implied volatility and investigate the dependence of the implied volatility on strike and maturities, and the dependence on the term structure, on the maturity, and it depends on the strike, this is the smile and skew, they can be observed. And the dependence of the implied volatility on strike maturity is further evidence that the Black-Scholes model does not correctly describe the reality of the financial markets. Obviously, if everything were perfect, the market would give you the Black-Scholes price. But the theoretical Black-Scholes price and the empirical market price usually differ. And if you plot it, and depending on the strike, you will see a curve that looks like this. And this is why it's called the volatility smile. So consequently, in the Black-Scholes model with a given parameter vector, there is only one volatility of the stock, which then determines the prices of all call options for any strikes and maturities. And consequently, implied volatility would be a constant. However, it's not a constant, it's not a flat line, but usually it's a smile. And if the Black-Scholes model was valid in reality, implied and historical volatilities would correspond. In fact, they do not correspond. However, the derivatives market and the option market is actually the one market in which you can observe few pricing errors. And this is even a philosophical question, because it's not as if the Black-Scholes model were so perfect to generate market prices, but it's just such a nice model that almost all of the traders use it for their calculations. And if everyone uses the same model to calculate theoretical prices, this herd behavior will force prices into the direction of the model and not the other way around. It's not like the model is able to produce the prices, but the way market participants act forces prices to become nearer and nearer to the model. Okay. Any questions related to the Black-Scholes model? Okay. Now everything else that can be done in option pricing is just an extension of the Black-Scholes model. A more complicated process, a more complicated derivative, meaning a payout profile in such a form that the Black-Scholes differential equation can no longer be solved analytically. So we'll turn now to jump processes, again as one example for a process that is more suitable to model the behavior and the time evolution of stock prices than a simple diffusion process. Now, we've seen in some cases we'll need a continuous process. In some other cases, actually, a discrete process would be more suitable. So for continuous distributions, the probability that a single event occurs is equal to 0, is close to 0. It's a very simple idea. That's why we need density functions and not probability functions. If you have a continuous random variable, the probability of the random variable taking one specific value, the probability is 0. Because there are infinite numbers on the real line. This means continuous processes are not suitable for the modeling of, say, credit default swaps, as the probability of an immediate loss would be equal to 0. What can you do as a remedy? You can use so-called jump processes, and we'll discuss the standard example of a Poisson process as the prime example of a jump process. What is a Poisson process? The stochastic process NT, with t larger or equal to 0, is called Poisson process with Poisson intensity lambda larger than 0 if the following holds. Starting value is 0 and 0 is 0. NT has right continuous path, rechtsstetige Pfade. We'll see in a moment what this means. For all n and for all 0 equal to t0, smaller than t1, smaller than and so on, tk, the difference ntk minus 1, for k between 1 and n, they are independent and they are distributed according to a Poisson process with a parameter lambda that is a function of the lag t minus s. What does this mean? Just like with the random walk or the geometric Brownian motion, we now have what? A stochastic process that starts at 0, which has paths that are right continuous, and the increments, the changes in the process, they are for all times, regardless where you're looking at the process, they are independent from each other and Poisson distributed. Before random walk, we had independent, normally distributed increments. Now we have independent Poisson distributed increments. And the Poisson distribution is discrete, not continuous. Some comments. Again, it starts at 0. If a process NT does not fulfill this characteristic, you can use the transform process. You can simply subtract N0, and we'll later on see the process will look like this. And very simple. If it starts at 5, well, then just take NT minus 5, and then it will look like this. And the same. So this is quite easily fulfilled. Right continues, see next slide. And we have independent Poisson distributed increments or increases. Now let's take one large step back in time. Let's go back to your math class in the first year of the bachelor's degree. What is continuity? When is a function continuous? Difficult question. When I studied management, business administration, my professor, a statistics professor, more or less explained and defined continuity and a continuous function by arguing, well, if you can write the function like this and you don't have a jump like this. For her, that was continuity. Now, in mathematics, continuity, there are several types of continuity in different mathematical spaces, but in the simple case of the real numbers of a complete mathematical field, What is continuity? Does continuity mean? It means, in one definition, that if you have a marginally small increase in f, this small increase in f is due to a very similarly small increase in x. You might remember this for continuity. This is the epsilon n0 definition of continuity. Epsilon, korrigieren Sie mich, der Kommiliton ist ein bisschen am Dösen. Ich mache Sie mal wieder wach. Epsilon n0 Kriterium ist das bei der Stetigkeit, ne? Ja, genau. Und Epsilon, Differenzierbarkeit ist Epsilon Delta, ne? Ja. And equivalently, you can also find that in this special case, in the real numbers, continuity can also be defined and expressed like this. A function f is continuous in the real numbers if we have for every sequence xn, which fulfills that xn goes to x, that we also have the limit of f of xn being f of x. And both things show basically the same thing, that you don't have any jumps in the function. But this is, it took mathematicians and it took mathematics as a field decades and even centuries to come up with such an elegant definition of continuity. Sage ich nochmal auf Deutsch. Man muss das immer wieder betonen, weil ich das auch auf dümmlichst dämliche Art und Weise erklärt bekommen habe im Studium. Stetigkeit ist natürlich anschaulich, dass die Funktion keine Sprungstelle besitzt. Ja? Sie können die Funktion in einem Strich durchzeichnen, ohne abzusetzen. So. Das ist die naive Vorstellung wahrscheinlich der BWLer, wie man hier sowas Feinsinniges wie Stetigkeit definieren kann, und das versteht jeder noch irgendwie. Stetigkeit in der Analysis ist aber natürlich ganz anders definiert, und es kommt dann auch immer noch darauf an, in was für einem mathematischen Raum sie sich bewegen. Wir haben jetzt hier nur die reellen Zahlen, da ist dann auch Stetigkeit und Folgenstetigkeit, so nennt man das dann, also Sequential Continuity, ist äquivalent, sind beides Definitionen oder Möglichkeiten, Stetigkeit zu zeigen, und übertragen. Sie kennen das vielleicht noch aus der Analysis, das Epsilon n0 Kriterium heißt einfach ja nur mehr im übertragenen Sinne, wenn die Funktion quasi sich um einen bestimmten Betrag verändert, dann tut sie das aber auch nur, wenn, ich mache jetzt mal hier sowas auf, also wenn sie quasi in so einem Bereich sich bewegen, dann müssen Sie sich angucken, wie stark schwankt die Funktion in diesem Bereich, und dann gucken Sie sich an, wie liegt das hier, und dann ist die Veränderung in x, spielt sich dann in diesem Kästchen ab, und das Ganze gehen Sie dann aber ins Infinitesimale klein runter. Und damit können Sie mathematisch auf super elegante Art und Weise diese Idee, dass die Funktion keine Sprungstelle besitzt, können Sie damit operationalisieren. Man könnte jetzt auch denken, naja, das ist irgendwie, es ist auch schlecht erklärt, gebe ich zu, klingt jetzt irgendwie ein bisschen wirr. Das hat die Mathematiker und die Mathematik schon nicht übertriebenermaßen Jahrzehnte, wenn nicht sogar Jahrhunderte gebraucht, um mit so einer Definition erstmal anzukommen. Und das so elegant zu zeigen. Und noch schöner ist natürlich die Folgenstetigkeit, die einfach nur was sagt. Also, wenn Sie eine Funktion haben und Sie gucken sich eine Folge an auf der x-Achse, also Sie gehen von x quasi hier hin zu dem Punkt x, dann gilt für diese ganze Folge, dass eine beliebige Folge hier der die Folge der Funktionswerte für xn, dass die auch gegen den Grenzwert von x, also f von x, strebt. Das ist Stetigkeit. Und sagt eben alles nur auf schöne Art und Weise aus, die Funktion hat keine Sprungstelle. Was ist denn dann aber, okay, let's switch now to English again. What then is now right continuous and left continuous? It simply means that in the definition above of sequential continuity, we had any type of sequence xn that goes to x. But it could be a sequence that comes from the right and goes to x, or it could be a sequence of numbers that goes to x, this is here x, that goes to x from the left. And this, if you have a function that at least for, if you can see here, xn is larger than x. So if all those sequences, they start at the right and they come from the right and go to x, they go to the left, then this function is right continuous. And you can also define left continuous. Why do you need this? It is important for a function that looks like this. This function is not continuous, but it's right continuous. Ja, also eine Treppenfunktion ist nicht stetig, aber sie ist rechtsseitig stetig. Vielleicht sogar schon in der Schule mal gemacht. Ja? Wenn man von rechts kommt, klappt es. Okay. And this is obviously what we need here with the jump process. The function can jump, but if you take a look at it from the right, it is still continuous. Poisson processes are partly constant, monotonically non-decreasing, show upward jumps of size 1, have an exponentially distributed waiting time, whereas t describes the waiting time until the next jump. So what type of jump process is it? We will always have jumps of size 1. What is random is the waiting time until the next jump. And we'll take a look at this here in Matlab. So this is a very elaborate function to simulate a path of a Poisson process. We have lambda, y max, starting value, the number of paths, and we want to avoid the monitor output. It's a function. It's quite simple. As you can see, we'll have the jumps and we only need the different times. So what is the waiting time until the next jump is distributed exponentially? So we'll have x, j, I plus 1, and here we'll take a random number from the exponential function with parameter 1 over lambda. And that's the simulation. We'll plot a number of processes. We'll do it here, and let's immediately look at the output. Those are two paths of a Poisson process with intensity 2. And as you can see, they will always jump up 1, and in this case it had to wait until this point to go up 1, and the second one had to wait until here to jump up. So these are two paths of a Poisson process, and there are several applications in finance, also in medicine. For example, in insurance, it's the time until the next loss is incurred. In medicine, the occurrence of a death in a clinical study. In IT, could be the arrival of a job in a call center, or the occurrence of a failure, of an error within a software program. In corporate finance, the sale of a stock on an exchange. So there are numerous applications for this. Now this is a Poisson process. This is not a jump diffusion process. So this is only a jump process. Now we want to use a jump diffusion process. So the problem is that Poisson processes do not look like stocks at all. So what do? We include a jump component in a geometric Brownian motion. And this will look different. Remember, geometric Brownian motion, our simple model from the Alexgoldschmidt model. And we'll take a look at geometric Brownian motion. Remember, dst equals mu st dt plus sigma st dwt. And we'll now include a jump component. And the jump diffusion process looks like this. dst equals mu st dt plus sigma st dwt plus, and this is now new, st, the process itself, plus the change in the jump process. Jt is described by Jt, the sum of I equal to 1 until nt xi, nt is a Poisson process, and xi are independently, identically distributed jump heights. The jump process itself always goes up by 1, and will include this process xi here. These are identically distributed jump heights. And jt is also called an aggregated Poisson process. Now, this is the differential notation here. In the explicit representation, st is given by st0 times exponential function, and so on and so on. And you can discretize it, also diskretisieren, to calculate a path of a jump diffusion process. So st plus delta t equals the previous underlying price times exponential function, and so on and so on. And you have to include all this. Again, you can see it's still a geometric Brownian motion in it. So you need to to simulate from a standard normal distribution to come up with one simulated path of the jump diffusion process. Let's do this in Matlab. We need a starting value, we need the parameters mu, sigma, lambda, t, the number of points on the x-axis, so how many steps into the future we want to simulate the path, the number of paths. If we want to simulate 10,000 paths, then nREPL will be 10,000, and we don't want any output on the monitor when we do it. So the function is called jpaths. It's that's the output. The function is called jump diffusion paths. We'll insert all those input parameters. We'll initialize the paths with zeros. Path, the starting point is always S0. The discretization of time is dt equals t divided by the number of steps. So t could be 1 year. If we are looking at 1,000 steps, we'll take 1 over 1,000. Mu dt and sigma dt can immediately be calculated because mu and sigma are given. Now, then, we have sigma and this one here. And now, for this third part, we have to simulate a path of the Poisson process. We'll take this function Poisson simulation we've done before. We'll have to adjust the Poisson process with our starting value, and we'll cut it after n steps. We'll take a regular grid for the Poisson processes, for the process. We'll take the first differences, and it goes on, it goes on. We have to decide whether there is a jump or if there isn't. Remember, the diffusion process will continue with each step. But at some points, the Poisson process will tell us, if this is the geometric Brownian motion, at some points the jump diffusion process will tell us go up, continue, go down, go up. And this is why we need to check whether there is a jump or whether there is no jump. But if we have simulated one path from the Poisson process, we'll know the waiting times. And the waiting times will tell us when we have to increase or decrease the otherwise regular changes from the geometric Brownian motion. So let's plot it. And this is how it looks like. 2 steps. And as you can see, it still looks like a stock price, but in contrast to geometric Brownian motion, you will see something like this here, or this here. So sometimes you have upward or downward jumps, and this is a jump diffusion process. If you were to include such a jump diffusion process, and make it even more complicated by using stochastic volatility. So if you take drift and volatility being random variables or functions in a random variable, and also a jump diffusion process, you would still use the same Black-Scholes pricing framework, but this then would something be for current research in mathematical finance, in computational finance. Mathematical finance is concerned about moving up the ladder for these processes that can be used to model underlying prices, using more realistic, more flexible models for the stochastic processes, and then trying to make the Black-Scholes model work under the assumption of a more complicated stochastic process. Right. Okay. Now, the next part is again on derivatives, and we'll repeat some more of the definitions, but I think I can stop here now. You can take a look at the Matlab program. Try to make it work on your computer. First, just try to copy it, insert it in Matlab. Should work on its own, and you can simulate some paths from a jump diffusion process. A jump diffusion process is already a nice flexible model for stock price. And as you've seen, it should be more realistic than the geometric Brownian motion. Try to use it in Matlab and see how it works, and see if you can understand all the details and the fine print of the Matlab program. Actually, when it comes to the exam, you will probably have seen from the exams from past semesters that there's always one Matlab question for 10 points out of the 90 minutes. And you will never be asked to program something in Matlab yourself, but you are asked to understand and interpret a program. And it is always puzzling to me why still there are some people who manage not to get the full points from this exam, from this question in the exams, because you will see that if, for example, you are given a Matlab code that includes a Poisson process, it can only be the jump diffusion process shown here. And if you see Matlab, I mean, these programs will never have a name or function. The function will be called differently. It will be JPath equal to function A or something like that. It will not be called jump diffusion path. But if you, for example, see that it includes a starting value as 0, mu, sigma, lambda, t, etc., it is obviously a function that is used either in option pricing or in the simulation of a path that will later on be used in option pricing. So make yourself familiar with the program, and what I can already describe to you and lay out to you in advance is why do we need these functions to simulate paths from this jump diffusion process? It's quite simple. We have seen that we are looking for the price of the option. And the only thing that is driving the stochastic behavior of the option price is the randomness of the underlying price. Now, a very simple approach to option pricing is to, if this is the maturity, then we have two paths under the assumption of a jump diffusion process, and we know the stock price could be ST equal to, say, 90 and ST equal to 40. Now, if this were a plain vanilla call, and K is 55, what would the option be worth for these two scenarios? In this case, 35. And in this case, 0. Correct. So what you do now is you take 35. Let's assume we have a risk-free rate of, say, 10%, and this is a year. Then we would use 35, discount it to t equal to 0, to today. Take 35, discount it, plus 0, discount it, (0.5, 0.5), just use equally weighted probabilities. All those scenarios are equally possible. And you will see that this vanishes, and this is your estimation of your option price. That is Monte Carlo pricing, and Monte Carlo simulation for option pricing. Take the stochastic process, simulate it, and simulate from it. Take the simulated end values of the underlying price, plug it into the payout profile, find out what the option would pay out under this scenario, discount it, and then take the expectation, the expected value, the average of those scenarios. With one slight extension. What would you do in practice? Contrast to what I've done right now. Yeah?
You would set a slightly higher price to earn something.
Well, imagine you are interested to find the right market price. You would accept the price you've calculated here. But what would you do in the modeling, in the Monte Carlo simulation? Remember back what Monte Carlo simulation was all about. You're standing in the casino and you're trying to find you're trying to calculate your expected profit from standing at the roulette table. Do you throw the number 2 times? Do you observe 2 games? No. Here we had m equal to 2. You will increase it and you will say, I will not simulate just 2 paths, but you will do at least 10,000 or 100,000 simulations. You will not base your pricing on just 2 paths, but you will use 100,000, 500,000, or 1 million. And that is why, and now you understand again why computational finance is so much about option pricing. The more complicated your process is, the more computer and the larger your computing power must be to calculate all those simulated paths. If you have a very complicated jump diffusion process, you will need computing power. And then you need to discount all those simulations and you have to make additional calculations. And this will eat up all of your computer's memory and CPU power. And that is why you need sensible and good algorithms to simulate and then to calculate the option price. And unfortunately, the better and the more flexible the model is, the more computing power you need. Because as you've seen, geometric Brownian motion is just simulating from a normal distribution. But here, this is a little bit more elaborate than simulating from the normal distribution. And we'll see this later on. We'll talk a lot about Monte Carlo simulation in the upcoming lectures. But here, you can already see the very simple and very basic principle behind it. Simulate from the process, plug it into the payout profile of the derivative, calculate the average discounted payout under all those simulations, and then you get the option price, or at least the approximation to the option price. And we'll see that we'll get close to the Black-Scholes price. Yeah? Okay, any questions? Well, if you have no questions, we'll stop here, and I'll see you next week. Thank you.